Amazing couple of days. For those of you who've been here since Monday evening, congratulations on your stamina.
Presentation.
Normally we do these panels to give everyone a bit of a chance to tell you who they are, but everybody here today, other than me, has been on stage already today, so someone's introduced them at some point, so we'll dispense with that. Again, I think, it was yesterday actually, you were on, Jamie, weren't you? Yes,
correct.
Yeah. And so I thought that we'd actually just right from the start, rather than go through a primer or ask me, because again, everyone's spoken, just to go straight to questions, because otherwise what tends to happen is we kind of all get talking amongst ourselves up here and then we forget what time it is and then there's no time for questions. So really, to end this thing, I think you've been listening to a lot of people for 2 days talking, you've heard a lot of different things. As Barry said, some things that have been said he totally disagrees with. I always loved the idea that heed the markets, not the commentators. But you've got to be a commentator to tell people to heed the markets.
An
observer. You've got to listen to what the markets tell you. I totally agree. I'm taking the piss. I love to read Barry's email every day. It's always very, very positive, very exciting, and has been very, very right. So it's very good. So I think seriously, you've got some amazing people up here. You've got a producer. You've got a wannabe producer.
That's obviously
no. You've got stockbroker. Well, you've got two producers. You're the producer. You've got the wannabe producer down the end, and we've got brokers. We've got bullion sellers. We've got another broker and raiser of money, and I'm someone who works with mining companies and tries to keep them in business through the cycle. It's very easy to keep them in business in the current part of the cycle. You just got to make sure they don't get too excited. So anyway, please, fire away. We've got some microphones out there. Some must have questions for the panel. Yes?
This is a bit of a wild one, but when Donald Trump wins the election, I think it's when.
Premise.
Ripples in the room already. I'm leveling this to you.
Just so everyone can hear the question.
Yeah, so when Donald Trump, not if, when Donald Trump wins the election, there may be a fair bit of pushback against that. There may even be a lot of civil unrest. If he claims that the left tries to steal the election from him and things get a bit feral, what impact do you think that might have on gold? Will it have any impact? Will it have no impact? Just...
Do you want me to jump in?
Yeah, I don't think any of us here actually has that kind of insight, but does someone want to have a crack at just sort of... Yep.
Well, at the moment, obviously, all we see is geopolitical tensions are driving the gold, one of the drivers of gold price right now. So anything, news and noise are moving the markets. And so when Trump gets in, according to you, we're likely to see the rally continue for gold, because investors at the moment, from a Bell Direct and Bell point of view, we're seeing they're sitting on the sidelines waiting for some form of normality to and stabilisation to come again. So once we get that, then we have this rally moving forward. But until then, investors are simply adding to their existing portfolio moves, and they're also getting into gold. So any unrest, like literally yesterday, we had gold going through the roof because of the Middle East tensions. That has nothing to do with gold. That has something to do with oil. But it's really boosted the gold price. And so obviously Trump getting in is going to really kind of fuel some tailwinds to gold again, because investors just want that safe haven nature, guaranteed returns in gold.
Yeah, I'd add one other comment just more generally, that whoever gets in, I haven't heard either one of them at any stage talk about debt and deficits. Right? I mean, they're both going to continue down the path of just America is going to spend more. It's just where they spend it or what they do. So if that's a driver for gold, if that's one of the reasons that people are looking at gold at the moment, that they are quite prolific, and as Henry said earlier, they're spending more on interest service now than they are on defence. And there's lots of commentary in the market about what that means for end of empire and all that sort of thing. But what it does mean is if that much interest, they have to keep printing more money to meet the interest bills, to keep doing it. That's got to be good for gold, I would have thought.
One more thing, sorry. The People's Bank of China is buying up gold more than any other central bank in the world right now. So I think they're going to continue to do so, especially if Trump gets in. So it's looking pretty good for gold.
If your presumptions are right and there's civil unrest after Trump gets elected, as a human race, human psychology, when we panic, we run to gold. We don't run to silver or Bitcoin or any of these other things. We
Why
run
not Bitcoin?
to gold when we panic.
I'm going to add something. I'm going to add something.
I said,
to that.
why not Bitcoin?
I think that's true of the West. Like, I think in the West we buy gold in panic. The interesting thing is the markets in the East, they buy gold all the time, and actually they sell it in panic. So during COVID, someone showed photos of all these people queued up around the corner in Thailand outside gold shops, and the uninformed Western thing said, oh, they're all queuing up to buy gold. No, they were queuing up to sell gold because none of them had a job, and they were redeeming their savings, probably getting some silver to buy sausages or satay. But it's that thing where they do. So I think it's interesting. The Perth Mint, when they're queuing up outside the Perth Mint, that's people in the West panicking. To your point, the really funny thing is often that's when the biggest transfer happens, when we all pay the highs and they sell out and buy other stuff. So yeah,
we often say that on a retail level. When spot goes up, we were talking about this with a few people. Spot goes up, we get busier. When spot goes down, people don't buy. It's the reverse of shares and specials on jeans and in Coles and that sort of stuff. With gold, it seems to be specific. When price goes up, people will buy. When price goes down, no one will touch it.
Yeah.
Yeah, it's the same with producers that hedge. No one wants to hedge at the moment. They're all telling you they're unhedged because it's high. Yeah. And then the worst thing when I used to work at the bank would be then the price would fall $300 or $400, and they'd all call up and they go, oh, and I go, no, you don't. No, tell me you don't want to hedge now. And they all sell the low, right? That's absolutely the case. Sorry, Brian.
So my colleague asked a more provocative question. I'll be less provocative in this one.
Mike's not on.
So I asked a less provocative question than my colleague. Where do you think is a breaking point in the West determining the price of gold through COMEX and the digital contracts that gets moved around in huge volumes to somewhere else? Because clearly we know, at least most of us in this room, feel that there is some form of gold price manipulation. The physical purchasers aren't actually driving the prices. It's what the large banks, the central banks, and all of them playing with the digital contracts. What do you think would be the dynamics in which the transition could happen, and who might be taking the ball to run with it? Because this game should end very soon. Okay, so before the panel answers, can I let's just see have a show of hands, because you made a statement there that we all know. Who in this room actually believes? Sorry, I'm framing that question poorly. Hands up if you think that the gold price is manipulated.
Wow.
Okay, so about half the room. Anyone want to touch that?
Look, you're honestly, Sean, you're probably the best to speak on this. But the way that I kind of look at this is, yeah, it's manipulated if you believe a network of contracts is manipulation, right? So if the biggest bullion banks are also those selling hedges, they do have to structure very large shorts at levels in the market. And these shorts, these hedge levels, they get built up at pretty defined levels as people consolidate these books of short positions over time to hedge the market. When you see a big physical buyer coming in and driving the price, you see the price moving through these hedge levels, and then you see it move up consistently. So you almost see like a structural reset in the pricing. This is a very, very difficult market to untie because there is everything from direct to indirect and synthetic contracts. But I think it's too easy to call it a manipulated market. Like, yes, people have been caught gaming it, but there's a lot of reasons why the price will be contained inside of hedged structures or hedging related contracts for a long time. Does that change? It really changes if producers say, I see higher prices coming, I'm going to forward sell less, I'm going to hedge less, and hedge books unwind. And then the people who might be in control of this market, their incentive is to be on the long side because they don't have to hold the short side. So it's a very complex question.
I mean, I actually worked in the bullion markets directly for 20 years, and I worked for Rothschild, so immediately some of you are going to go, I was part of the conspiracy. But I saw people, and I understood that people manipulated the market on a daily basis, and one of the ways that the market is manipulated is lots of very large producers give all their gold to be sold on the PM fix, which is 3 o'clock in London. So if you're a trader in London, you're not going to be long gold at 2:30, right? Because you know there's all this selling is going to be set at 3 o'clock. So you go short. And what happened is they had a court case in America some years ago where someone showed the daily thing, and it was like you could see they reckon you can see the Great Wall of China from the moon, right? It's one of the few features you can see in the world. Well, it was this obvious, like 3 o'clock and 10:30, and they said, well, the price is manipulated. And you go, no, big producers are just really lazy. That's when they sell the gold. And if everyone knows that's when they're selling it, then you sell early. So there's that short-term manipulation that happens. But the longer-term manipulation, to Alex's point, if JP Morgan's got some massive short position on the silver futures, that's probably because they've got a massive long position in the physical and they're just hedging it. And the people at ABC all probably went and bought houses in Palm Beach on the strength of the money they made during COVID when New York futures was short and you couldn't easily get metal into America because of the change in the planes, and the futures got out of line. But what we saw is all of a sudden COMEX was trading at a huge premium and everyone's going, oh, the conspiracy people are going to get it now. And we just flew gold over there from somewhere else in the world, from a discount market at premium, and it all levelled out. So I think you're better off to believe in gold. There is no conspiracy other than the conspiracy to just grow debts and deficits by governments and be on the other side of that, would be my suggestion.
Did you see any example of large off-market contracts, over-the-counter arrangements?
Oh, before the EFT, there was always huge, off-market trades that people would do because hedge funds want to be long or hedge funds want to be short, and they all agree that in the OTC market. And then the banks might lay that off in the futures, or they might lay that off in the Loco London. I mean, that's one of the nice things about the ETF now, is to the extent that it's easier for all the funds to buy the ETF, we all get to look and see what the volumes are, so we can kind of see what those flows are and see the behaviour. But there's still lots of reason for people to do trades off market. But it's like in 2013 when the gold price collapsed and everyone said, oh, we've been robbed and manipulated. But we can all look quite clearly at the graphs that Barry put up today about the S&P versus gold, and it was really quite clear that stocks were starting to outperform gold, and all the generalist investors in 2012 had fun, been long for 5 years, and all tried to sell in 5 weeks what they'd accumulated in 5 years. And when that happens, if everyone in your street wants to sell their house on the same day, you're not going to get the price you think you're going to get today. Keith.
Question
Oh, sorry.
Yes, I've got a question, probably directed to Barry, really. I saw the chart of the Dixie where you showed the DXY heading to 120, 130, something crazy. Do you think, and then you showed a chart about, the gold price going higher. Just want to understand, I would have thought the Dixie going higher would be a definite headwind to the price of gold.
No, I like to think of gold in terms of supply and demand and tonnes. And so if we've got central banks, but more importantly, Asian, Chinese and Indian demand for gold, which has really been taken off the market. So it's really tightening. I think it's a fallacy to think that the gold price and the US dollar are inversely related. And there are periods of years where both of them have gone up together. So, when I say heed the markets, what are the markets telling us? Because so much of what the market is actually saying is not what the commentary is. That's the point I'm trying to make. So, when I look at the dollar and then I look on the other side of it, 57% of it is the euro. I'm really not sure that the euro is going to be with us for very long. And when I look at the yen, and the euro is 57%, the yen's about 13%. I think the yen is going to collapse. for all the reasons. It's got all the signs of that everyone thinks about the America having the debt. The Central Bank of Japan has got 180% of GDP as debt, it can't move, and the yen's falling. They're going to keep their US dollar treasuries. That's sort of keeping them up. If they start selling that to buy the yen back, all that's going to happen is that people realise they don't have any reserves, and what we're seeing is the stock market's going up in this parabolic surge. Now bonds in Japan are there at 0.96 on a 10-year bond. 0.96. It's ridiculous. Oh, and I'm sorry, I forgot to make the major point. What we see in these currencies is the European currencies and the Asian currencies, they're all energy importers. And the US dollar is essentially an energy exporter. It's an importer, but it's really an exporter. And Australia's an energy exporter. So the A dollar looks really strong on the cross rates against the euro, against the yen. I mean, I've been talking about this for some time, but it really says to me that there's a real energy issue that's going to affect all these other currencies. And when we talk about all these fiat currencies, the real problems are Europe. The real problems is Europe and Japan. They've got the real fiat currencies. So think of the gold price going up with the best of a bad lot. And the American economy is by far and away the most dynamic. And I've got my views about what's going to happen in the election and what will happen after that. I'll probably talk about it later, but it's really important.
Conscious of time. So is that you happy with that? I mean, it sounds good to me. If US dollar's going up and the gold's going up, that's probably good for Aussie dollar gold price. Yep.
So Barry, before I ask you the question, I just want to make sure I got your presentation right. You said that the stock markets are going to be going up and Bitcoin's going to tank.
So what's going to tank?
Bitcoin is going to fall and the stock market's going to go up.
That's what the markets tell me, okay?
Right. So my question
That's what he observes.
That's what I observe.
Right.
Yep.
So I noted that you very much like correlation. Now, if you look at Bitcoin and NASDAQ, the QQQ, they're very highly correlated.
Yes.
And it's been a canary in the coal mine. Every time Bitcoin's gone down, the market has followed. So I think Bitcoin personally is the ultimate risk asset. So why would you think Bitcoin's going to tank, but the stock market, why would they decouple?
Look, one of the really important things to understand is just how big the US stock market is in terms of capitalisation and how many different sectors are in it. This is really important. This is why, again, you've got to look at the markets. You've got to look at the subsectors. Too many people just look at the SPX or the NASDAQ and they don't look at all the other subsectors. You look at the oil and gas sector. You look at the materials sector. You look at the transports. You look at the utilities. You look at the Dow 30. There's only 30 stocks in there. They're industrials. It's not the S&P 500 with 500 or so stocks. So we can see NVIDIA falling sharply. We can see Microsoft falling sharply, Amazon falling sharply. Can affect the overall index, but it's not going to bring the whole thing down.
So you're saying MAG 7 could fall dramatically. That means Bitcoin falls because it's highly correlated to them, but energy and industrials and all those things are then circulating back up.
Can keep going.
Right, okay.
Look, I don't want to talk too long, but one thing I really learned when I was in funds management in the early 80s was the rolling recessions that took place in the United States. We had the Rust Belt and the oil patch in the US, and that had major impact on employment and activity because they were important in America. But while that was going on, all the changes that came through from Silicon Valley, and we saw the movement of people into Florida, all sorts of other technologies developing, defence industries, All these things were moving at a different rate to what was happening in terms of the Rust Belt and the oil patch. So keep that in mind. Always think it's a dynamic thing. There's lots of components.
Before we ask another question on the floor, I'd like to, Jamie, I'd like to ask you a question, because I think one of the main questions that's kept on coming up for the last 2 days is why are the gold price so high and gold stocks, we haven't made the money in gold stocks that we thought we would. You know, we look at our portfolio and go, if I'd thought gold price was $3,700, I think I'd make a lot more money than I am today. You, as a gold producer, and therefore talking to the major investors in the gold sector, what are they telling you as to when you talk to the big fund managers and things like that? What do they? And then we'll go to Grady as well. Like, what are you hearing from these major institutional investors? What's the roadblock?
Yeah, look, really good question, and we've had the same thought ourselves. Obviously, when gold first broke through sort of 2,300, 2,400 US, 3,500 Aussie going north, there was a decent run. There was a real flurry. Obviously, a lot of the gold producers, the stocks ran up. And, we were case in point. We were 60, 70 cents better than where we are today. And the market's actually only improved since then. And one of the things we hear, even if you're putting out good news flow and you've got, good production guidance or you've got good ounces, is it seems to come down to quantity now. The funds and the large funds are saying to us they want to see 200, 250,000 ounce plus operations. It's about scalability. They're interested in the juniors, but only if the junior is going to grow into a major. And I think there's a lot of that behind it. And it is particularly frustrating because, and in fact, I was talking to the Southern Cross Gold guys there earlier today, and they made a good point. They put out a really good drill result, and they went down on that. And it's just, and that's a project that's got scale. So it is very confusing as to why there's not the recognition at the equity level for the gold producers. The results are good, the price is strong. There's no other obvious impediment that we're hearing other than scalability, be big in the space.
Grady, do you have anything?
Yeah, I think high input costs are a concern as well for a lot of investors. Obviously, as I said before, all of our investors are sitting on the sidelines waiting for a stabilisation in the market. Then they're just adding to their existing positions right now across the market, not just looking for new opportunities. So I'm not sure if you guys saw the chart that I had this morning about all-in sustaining costs rising. And they've been rising not at any fault of the gold miners themselves or producers. It's simply wages inflation is so high and sticky, labour shortages, we have had COVID-19, we had so many other things that are driving the all-in sustaining costs up. So while there are so many producers out there that have really low all-in sustaining costs, investors are really wary about the all-in sustaining costs eating into margins at the moment. So that's kind of where the sentiment comes from. But I think there's a lot of buying of bullion, there's a lot of backing of ETFs as well, but for me personally, I think there's a lot of opportunity in the gold space that investors are really not snapping up, and I think that will be exposed soon, and we'll see the gold miners run.
Sorry, Keith, you had a question there. I know, get that microphone hot in your hand.
On that manipulation, and all these fines that JPM regularly pay for spoofing surely is manipulation. Yep.
Short term though, intraday, that's all that stuff has all been,
they've done it like year after year. But anyway, look, let's forget about manipulation. The question I'd like to ask is, I forgot what I was going to ask. No, the question I was going to ask was, S&P just gave a forecast that the gold price has peaked at 2,500 and is now going to collapse down to 2,200. And then gradually disappear off the end of the page over the next 3 years, by the looks of it. Starting off with Sean and the rest of the panel, what are your views or comments you want to make about that?
I had to rush out to see someone, so I didn't see the presentation. I firmly believe, I said in a presentation with Headley yesterday, I said it last year this time, and I said it 2 years ago, Keith, when you asked where do we think the price question is going to be. I think if you sell something today and you use that money to buy gold, you're going to be able to sell that gold and buy more of that something else going into the future. I think gold will continue to outperform to the extent that Barry's chart is quite compelling, that gold stocks may start to outperform gold. I think is quite exciting. Gold is a tiny little market, right? Like, we're all here excited about it. It's a gnat on the bottom of an elephant if you look at the international markets. It's an irrelevant market in the scope of international markets, but it's a global market. So it gets this kind of perception of being very big because central bank own it and stuff. It's just a tiny, tiny market. If everybody outside this room decides they get religion like here and they want to buy it, there isn't enough supply. That's the really exciting thing about gold equities. So I don't see anything in those charts that suggest to me that gold isn't going to continue to outperform equities. And so I remain very bullish gold. I don't know what S&P's basis for their thing is, but everything I look at, like Barry, as an observer of the markets, until the markets change their trend, I'm sticking with the trend, I'm sticking with the trend that's there, and the trend is gold is outperforming. It's sniffing out something. So that I take a bullish view, and I'm happy, with that.
Can I just make another observation? Look, I'm a stockbroker, and people know me in the gold sector, but my phone ain't ringing hot. We've got $3,700 for gold. My phone is not running hot. Now, I've also published, as you would know, there's $1,150 billion. That's $1.15 trillion in savings bank accounts, and that's increased by almost 300 billion in the last 2.5 years. So, and what I see in the markets is a lack of general participation. Now, whether a lot of the union super funds and industry super funds and whatever are taking a lot of that cash and putting it 30% overseas or only into the big stocks, and we're not seeing it because the managers of those funds. Shut up.
Everyone's got gold price view, Keith. So what's your gold? Your bullish gold?
Yeah, 2,800, then hopefully 3,300 first quarter.
Jamie, I know what you're going to say.
Oh, look, I'd like to see it 3,000 plus, but I think realistically, if it was 2,750 in the near term, we'd be very happy.
I only see it going up from here.
Yeah, I'm bullish on gold. There's too much behind it. There's way too many factors contributing to the rally that's ongoing. Trump gets in, it's going to keep going. So, yeah, 2,700 I think is the outlook I've had for a while now.
So I won't call the price. I will say last year, I think almost everybody was asked, where do you see the gold price by the end of next year? And everybody was very comfortable with the $2,500 level. I think that was pretty consistent. And here we are sort of halfway through the year, we're there. My view is that it's a bullish market for many of the reasons I've discussed earlier in the conference. We are seeing a structural readjustment in how gold operates in terms of global trade systems. Right. Gold has to be remonetized for energy markets and other commodity markets to be de-dollarized or partly de-dollarized. And this is the first time we've seen a credible challenge to Western NATO US dollar hegemony. So that I think is really important. Going back to the gentleman's question about Trump, US politics, I think the other thing to remember here is one of the surest predictors of a bullish gold price is sustained US rate cutting cycles. And I think the market has priced in probably one or maybe even two cuts in that rate. But if you see a third cut and a fourth cut, that will be one of that signals that makes it real to people that gold is going to react the same way. And it won't matter who has won the election, because that is a clown car and it's on fire and it's upside down and it's flying through the air. And they're all in the same vehicle. They are all stuck between the same short-term re-election incentive and disastrous monetary policy and debt. So it doesn't matter who wins the election. They are all driven by the same things, and these things are going to be inflationary.
Well, if you get the third and fourth rate cut, that's rate cuts because the market's falling apart, and to the extent the market's falling apart, those charts that Barry put up or I put up the other day about Dow Gold, they're all gold is outperforming equities. More money is flowing into gold. That's only good, I would have thought. The clock has stopped, but no one's come on stage to drive us off. So let's keep going until they do. Although you all probably want to start doing the prize draws. So yeah, question there.
I just had one about the stock price, the gold price. And probably more it's in the junior, the developers and the explorers, and that over the last few years, most of them have raised a fair amount of money, and quite often to do that, they're actually issuing shares to do it. And so therefore, a lot of these companies have got a lot of shares that are worth not a lot of money anymore, and so I find it a bit difficult for the share price for those to actually go up a lot, and I just don't know what anyone else thinks about that.
Yeah. Look, that's a really good point, and one of the things we do at Kingsgate, we've always been more debt focused. In fact, we've only been to the equity market once in a decade, and we've kept a relatively small capital structure. We've only got 260, 70 million odd shares on issue, and that's how we see we can drive value as the gold price goes up. Look, I agree with you. I know at various stages, development plans, companies need to issue equity. The one thing I would say, the other thing we're hearing from some of the funds is that debt is harder to get than it was. Ironically, it shouldn't be in a market like this, but there's more hurdles, there's more environmental regulations, there's more uncertainty. Debt is harder to get, and I agree with you. I think if you can get a company with a capital structure that's relatively tight, you're going to get the returns, and you'll see that capital growth in the share price. But I think there's some very good gold producers out there that have a lot of shares on issue. I don't think you're going to get anything more than maybe dividends in the future, to be honest.
Can I just
one more?
Just one question in terms of, there's no one talking about, if you believe it's $1.10 or $1.20, which we saw in 2011, when they realised, between 2009 and 2011, we saw the currency go from 55 cents to $1.20. It seems to me that...
Talking about the Aussie dollar, Joe?
Yes.
Yep.
The best judge, I think, of really realising we are in a bull market, and we haven't really been able to see that in the stock prices. But the one thing you can really look at is that whenever we've got a really big global bull market in gold, it seems to be that the South African rand, the Canadian dollar, the Australian dollar, and the Swissy are the only things to watch. And if they're all strengthening, we're at 68 cents at the moment. It seems like it's growing dramatically. But that seems to me when you can be very comfortable you're in a really bull market. And it's just, I reckon, the last few days, a week, we're starting to see the strengthening of all those commodity countries, if you like. Noah's rule, you obviously would be saying not to hedge. You'd be hedging the currency now rather than the metal. Is that correct?
You've been reading our stuff. So, our big, just very quick on that, because like I've got all these clients at the moment that are all making these public statements that we're not going to hedge anymore. You know, we're not going to hedge. And okay, that's cool. Like I actually at 2000 we said to a lot of our clients, we think you should reduce the amount of gold you're hedging because it's in a rising price. You know, you've seen my chart's got a green background. No one wanted to do any less than that because they say, oh, we don't want to do that because you don't want to change what you're doing because it upsets the market. You've got to be consistent. Now it's $500 higher. Now they're trying to reduce. So I'm saying to them, okay, well, that's cool. But if that's your view, we've got to be buying calls on the Aussie and you've got to be hedging your fuel. Because if you're getting bullish gold, you should be bullish oil and you should be bullish you should be bullish the currency. So yes, I mean, absolutely, if that's the swing that's coming, if you're bullish gold, you should be bullish the Aussie, and you should be bullish oil and those things. And your currency comment's absolutely right. And the really interesting thing is the interest rate differential is we're not really holding the Aussie back. We've got higher rates than, we got lower rates, than the US, but everyone can see that gap narrowing because our central bank's saying we're standing firm at higher rates. The Americans are clearly going to cut. If you go and look at that interest rate differential in the early 2000s, the thing that kicked off all the commodity currencies, all of that stuff was when the US interest rates came down and all the shorts in those positions all turned around, everyone went along the commodity currency. So I watch every month, rand, Canadian dollar, all the commodity currencies. I'm looking for those to universally all turn green on our charts, which will say that the flows are coming into the commodity currencies as commodity proxies. But we probably won't see that till the general equity market rolls over. And Barry's told us that's not going to happen, so it might be a little while yet. But yeah, that's the theme, absolutely.
Ladies and gentlemen, it's been a fantastic panel discussion, but as always, I like to keep to time. Sean, your energy to close and recap, and all the panelists, thank you so much. Let's